And so in this video, I'm going to talk a little bit about the income statement. So the income statement is always for a period of time. So for example, for the period ending, for the quarter ending, for the year ending. So it's always for a period of time, which implies a beginning date and an ending date. Now at the top line of the income statement, you're going to find sales or revenue. And then if we kind of start progressing our way down the income statement, gross profit is going to be the sales or revenue less the cost of goods sold or cost of sales or cost of revenue, those kind of items. And then, so once you take sales or revenue minus the cost of sales, cost of revenue, whatever that next line item is, then we're generally going to get to our gross profit figure. Now, if you progress a little bit further down the income statement, you start taking off various other operating expenses. That's going to get us down to EBITDA or EBITDA. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization. So basically, it's kind of driven by your operations, but before we have accounted for depreciation and amortization, which is those are non-cash expenses, and then also the interest and tax. Then if we take the EBITDA, and we take off the depreciation and amortization, then we're going to move a little further down the income statement. And we're going to have what's called EBIT, or earnings before interest and tax, which is sometimes also known as operating income. So that is the income that's coming from your core continuing operations. And it does take out the depreciation and amortization with the expectation that those, even though they're non-cash, were sort of an expense that your machinery was used up to some extent. So we get to EBIT, which is our operating income coming from our operations. Then if you take our EBIT and we subtract off interest, we get down to the earnings before taxes. So that's called EBT, or earnings before tax. And so that's basically, I've moved past the interest, which is driven by what's going on with debt. I'll come back to that point in a moment. And then I take off the tax, and what I'm left with is just then earnings, which is also known as net income. So that would be my bottom line. And so hence that's called the bottom line. So if a firm says that they've improved the top line by 10%, what that would mean is generally they've improved sales or revenue by 10%. If they say they've improved the bottom line by 15%, that means they've increased net income by 15%. So when you see top line and bottom line, that's basically what it's referring to, literally the top line of the income statement or the bottom line of the income statement. Now, as it relates to EBIT and earnings before interest and tax and things like that, and EBIT coming operating income, what's worth noting is if a business has one-time expenses, so some type of calamitous loss or something, a hurricane goes through and wipes out their facility, some type of one-time event, and generally that will be classed further down the income statement, so not in the data leading up to the EBIT, but as separate expenses due to the one-time line item. So those special events are generally below, hence why EBIT is considered more the operating income coming from typical operations, and one-time events are actually typically lower on that income statement. That brings us to a few things as it relates to points of analysis for income statements. So first off, net income, once I get to that bottom line net income, it goes to one of two places. It's either paid out as a dividend or it is retained. Now, if we back up for a minute, the company is owned by the shareholders. So the shareholders are the owners, and therefore, if I ask, to whom does the net income belong? The answer would be, well, it belongs to the shareholders, because the shareholders own the company, so the net income belongs to the shareholders. So we can either pay the net income out to the shareholders, which would be a dividend, or we can retain it. Now, that money belonged to the shareholders. So if the company is retained, it's kept by the company, which basically means the shareholders have opted to reinvest the money in the company. And so basically that's an additional investment in the company, which means the investors are expecting the company to make a return on that. So it's not free. It's not free money for the company. If that money is retained, and then the investors are expecting to earn a profit off that. So the net income goes one of those two places. Either it is paid out as a dividend or it is retained. Okay. Now that brings us to NOPAT. NOPAT stands for net operating profit after tax. So if I took two businesses that were identical in every respect, okay, so completely identical in every respect, except one thing. One business, let's say this business is financed half with debt, half with equity, and this business is financed just with equity. So this business, because it has half debt, half equity, it's going to have interest expenses, almost certainly. So if I'm working my way down the income statement, it's going to have interest expenses, which means even if everything else is identical, there's going to be an interest line item. which means my net income figure is going to be lower for this business than for this one. So even if they have the same sales, the same cost structure, other than interest, if everything was identical, then this business is going to wind up having some interest expense and therefore lower net income. This one would have no interest expense because it had only equity, no debt, and therefore it would have a higher net income. So one of the challenges with this is basically my net income is being shifted based on how the business acquired the money it used to buy the assets, whether it used debt or not. So that raises the question then. So if this business has interest and therefore lower net income, is that worse off than this business with the higher net income? The answer is hard to say. Because this business, although it has a lower net income, it also has fewer shareholders. So it has fewer people, or fewer shares at least, between whom to spread the income across. So that means these investors could have possibly made more money per share than these investors, right? So maybe these investors are actually doing better. However, by taking on debt, there's risk associated with that. So that means these investors over here that have a certain amount of they're investing in a company that has a certain amount of debt, they may actually potentially have less net income, but they would have possibly more earnings per share, but also more risk because of the debt. And these investors over here, the company has more net income, but possibly less net income per share, but with less risk. So trying to evaluate those gets a little bit more tricky. So when you start looking at companies, even in a very simple case, comparing just on basic net income is kind of problematic. So with that in mind, one of the things that we can do to try to compare businesses a little bit more evenly, perhaps, would be to look at NOPAT, net operating profit after tax. So NOPAT is going to take my operating income, my earnings before interest and taxes, and act as though that was our profitability. And then it's going to multiply it times 1 minus the tax rate. So T is the tax rate. And basically what we're doing here is we're kind of saying, all right, I'm going to set aside that whole issue of how the company got money. And we're just going to look at the operating profit. So even with those two companies that were identical in every respect, save the amount of debt, at the EBIT level in that example, they would have the same level of EBIT. And then therefore, I would get the same NOPAT figure if they had the same tax rate. So they would show up as operationally equivalent firms, even if they were a little bit different due to, in terms of net income, based upon the fact that one had debt and the other did not. So NOPAT's a more fair way of comparing the operations of a firm, because it's going to be based on that operating income and acting as though we're paying taxes on that, than if we use net income, which kind of gets skewed a bit by that debt choice. Hopefully that makes some sense. One of the things that we'd want to look at when evaluating the income statement would also be things like how much of the revenue became profit. So let's look at that bottom line and compare it to that top line. How do we do? And you could also subdivide the income statement and kind of figure out, well, how are we doing it at the gross profit level? We could look at how are we doing in terms of those various operating expenses after the gross profit, and start kind of diving into what's happening on the income statement and where are the expenses changing and things like that. And so that's where you start getting into answering questions like what's the composition of expenses and how have they shifted over time. So maybe my profit margin didn't go anywhere, but my cost of goods sold went up, but my amount of taxes went down. So that's an interesting thought to look at that and think, well, wait a minute. So it doesn't mean that nothing happened. It just means that things kind of offset each other. And maybe I had to look into like what happened with each of those items and then think about what does that mean going forward. Hopefully that makes sense, and hopefully that gives you a little bit of an idea about some things we might look at for an income statement. Thank you so much, and have a great day.